Well, hello and welcome back. Today we have a critical jobs report to review. It is going to be a pretty big deal. It's mostly going to be a pretty big deal because we had a JPOW who kind of thought that some of the prior reports that we were getting were not that big of a deal. And as a result, now JPOW's put a little more weight on the current jobs report. And the current inflation reports coming up. So something to keep in mind. So usually the jobs report isn't that big of a deal because we're not really expecting to see a big move down in the number of jobs that were created. Partly because of immigration, partly because of a strong economy. But today, what instead we're really focused on paying attention to has to do with the reality of what's going on with wage gains. Wage gains is going to be the big question, mostly because even though we can have a strong jobs number, which is good for the economy, too high of a wage gains number could set off the Federal Reserve to pay attention to the risk of a wage price spiral. And so we don't want a wage price spiral. We want wages to grow at a stable level without inducing unnecessary inflation. This is a very big deal. A lot of people here, wage gains, wages should just solely be going straight up. Well, I agree. Wages should be going up. But there's a reasonable rate, and then there's a rate that creates a substantial inflation and actually more risk to the economy. And so a wage price spiral is one of the red lines for the Federal Reserve. But not only is that one of the red lines, so is unanchored inflation. So far, JPOW's kind of been blowing off inflation for the first few months here. So let's see what can happen. This is going to be really interesting. So this report comes out in about 2 minutes. And we will be obviously covering this and going through all the details of it. So we are going to do a quick little test to make sure we can listen to C and Besizzles, and that we can listen to anything else that we need to. There we go. Okay, audio's good. And then they're actually on commercial.
Big thing in diabetes.
Yep, we got audio of them talking about diabetes. Okay, got it. All right. So let's go. The report is due within the next 90 seconds now. And, here's the thing. If we get a soft wage report, all the attention's going to move over to CPI. So it doesn't necessarily mean we're straight up. Although if we get a soft wage number, it's probably going to be pretty bullish for trading on the day. Probably going triple Qs, whereas if you get a rough wage number, probably going triple, or you're going to go with the S triple Q, the short. So we'll see. Alrighty now, we are getting pretty dang close. So we'll have this report. We'll read out the headline numbers. Really, the first one I'm looking for is going to be 214 for the non-farm payrolls number. And then I'm going to be very, very curious about those average hourly earnings. That's going to be the big one. So here we go for the BLS jobs report. Another thing to keep in mind is today is coupon code expiration day. So any of the trade alerts you want, make sure you're part of the Stocks and Site group. And then warrants expire Monday, and check out the event tickets. All right, here we go. I'll link below. And we're at match on average hourly earnings match month over month 0.3, 4.1 year over year. That's a match. Jobs report comes in way hot though. 303,000 jobs versus 214. 303,000 versus 214. That is leading to a fat red candlestick on the Qs right now. You can see it here, mostly because that is excessively hot. It is suggesting that the Federal Reserve is basically doing nothing to limit jobs. This is like the opposite of a weak jobs report. It's very, very strong. And those inflation hourly earning numbers did come in bang on at expectations, which is good, But 0.3 is still higher than where we want because it annualizes out to, we just got a bad revision to. 0.3 annualizes out to 3.6. The prior wage gain was 0.1, and we just got a revision that actually moved that 0.1 up to 0.2. So we moved the prior average hourly earnings up higher, and we just came in with a very, very strong jobs report. That this is a miss of almost 89,000. So let's take a peek, see what we've got in the actual docs. We'll listen to him for a moment as well.
4.1, as expected, down from 4.3. Actually, when you look at 4.1, you have to go back to June of 21.
This is true. And now that is the year-over-year number. But again, we're focused on that month-over-month. That month-over-month expected to be 0.3. We got 0.3. But the prior of 0.1 was revised up to 0.2. And 0.3 is still too hot. You really want to be around 0.25 on a monthly basis. Okay, let's go into the actual reporta. So total non-farm payroll rose by 303. And at the same time, we'll kind of have an eye on what else suits are saying here. So let's see, labor force participation rate did increase to 62.7. But yeah, another whopper, they're calling it. Okay. All right. So let's see here. It'll be interesting to see exactly how the market tries to parse this out, because really you get these big jobs reports. It's kind of good for earnings. The question though is like, okay, like what's the Fed want? So anyway, household data, both the unemployment rate at 3.8% and the number of unemployed people at 6.4 million people were little changed. We've got, among major worker groups, the unemployment rate for blacks was 6.4%, Asians 2.5%, Hispanics 4.5%, and adult men 3.3%, women 3.6%, teenagers 12.6%. Long-term unemployed, those jobless for 27 weeks or more, 1.2 million, little changed. Labor force participation rate, were little changed in March. Let me see, because I see some suits mentioning, okay, it ticked up 0.1%. The expectation was you were going to get 62.6%. You got 62.7%. So a little bit of a pop-up right here. The number of people employed part-time for economic reasons, 4.3 million, little changed. Got it. Establishment data, 303. Healthcare added 72,000 jobs. Ambulatory care services, hospitals, nursing, residential care, employment in government increased by 71,000. These are late cycle. Healthcare, government, late cycle. And that's about 141. It's about half. It's not bad. Sorry about that. Okay, construction added 39,000. You've got leisure and hospitality at 49,000. Employment and other services, 16,000. Social assistance, 9,000. That's going to go back into the government bucket there. Employment little changed in retail trade, 18,000. Little no trade or change in mining, quarrying, oil and gas, manufacturing, wholesale trade, transportation, warehousing, information, financial activities, and professional and business services. Average hourly earnings moved 0.3%. Let's do the actual math on that. So, oh, they don't give you the prior number. Oh, that's a bummer. Okay. I was hoping maybe we could see if that 0.3 was a round up or a round down. It looks like it came in actually exactly at 0.3. Oh, all right. Let's keep going here. Average work week edged up to 0.1. That's actually good for the economy. I don't think this is actually like a really bad report for the economy. You got more work. So think about this. More workers, more work, and at expectation inflation for wages. Not bad. Like, it's hard to say it's certainly not recessionary, right? It's not a recessionary report. And it certainly just, I guess it doesn't give you the benefit of, in-line wages yet. Not in-line wages yet. And this does, of course, come before the May numbers, which are expected to reflect April's wage increases that we saw, especially in California, fast food workers. Those are expected to have a little bit of an uptick on wage gains. So let's see, total mostly because that has such a big impact over the entire country. Bloomberg Intelligence thinks 0.2% of ECI can be boosted up, or ECI could be boosted up by 0.2% solely because of the fast food wage increases in California, which is wild. Represents like 0.3% of the entire labor force. Change in total non-farm payroll for January was revised up by 27,000. Okay, let's see what else we have from Suits. Okay, let's see here. Fed swaps shift to pricing a full rate cut to September from July. Okay, that's really interesting. So market's now pricing 100% chance, 100% rate cut just moved from July to September on this data. We have yields are up, 10-year up to 10.386%. We have gold up on this, 23.23, and Brent is sitting near that 91 level. Okay, good. So not a recessionary report at all. Let's listen in here for a moment while we get the next tables.
It's 62.8. We had it in November, we had it in September, we had it in August of last year. So even though it's important and it's jumped from 62.5, it's not like we haven't been there and done that rather
Yeah, and
recently.
we're still below. You're right, Rick. Rick, I could see that point. We're still about a half a point below where we were, although I got to look at the prime age number, which I'll look at in a second, but that, I think, had already exceeded it. But we have this issue of seniors actually having dropped out of the workforce, and there's a weird situation of them not coming back. And that's
okay, here as well, the unemployment households report. Yeah, I mean, the participation rate went up, so I don't know how much that really matters regarding with seniors who are dropping out and not coming back. It seems like plenty of other portions of the economy are willing to fill those jobs. Take a look here. This is the households report, and the households report is actually indicating a change of 498,000 employed. So yesterday there was a lot of debate over a potentially weaker households report. I mean, look at this in reality here. You had a report here of headline payrolls report, which is 303,000. And then you have the households report, which comes in at 468. So households, 468K. These are pretty non-recessionary numbers. Now, of course, we know that unemployment lags, and this can roll over very quickly. We were researching this in a course member live the other day. For all of those of you who have lifetime access to those course member lives, one of the things we found is that the unemployment rate could substantially change within the span of really just 3 to 6 months. It doesn't take long to really turn the jobs report into a recessionary indicator, mostly because it is a lagging indicator, and the lagging information changes very rapidly. It's almost like everybody all of a sudden hits the recession switch at the same time. But anyway, okay, yields in the dollar spiking a bit on the report. U.S. labor market refuses to quit. SOFR rates up, pushing back rate cuts now. That's getting priced in later. Let's see here. Fed swaps move full pricing to September from July. We saw that. And let's see here. Looks like Nick T has something to say. Another month of very solid U.S. hiring. Payrolls rose by 303,000 in March, and private sector firms added 332,000. So that's the non-farm number and then the private sector number. The unemployment rate ticked down to 3.8 from 3.9%. Okay. Payrolls, yeah, way higher than Wall Street estimate. No kidding. I always think it's funny when they do this, because this shows you, I'll show this in one sec. This shows you where the estimate is and where it actually came in. I kind of love this sort of chart. So this is where the estimates were, the red bar charts. These are sort of number of economists. And there's reality. This little, yellow diamond over here. Oopsies. Quick market reaction, by the way. Looks like we're getting, let's see here. What do we have? You actually have the Qs that are stable to where we were when we started. You've got Tesla rotating down on this, probably because you're pushing back rate cuts. You've got Enphase rotating down. Enphase was already down on this, wasn't it? No, it did move down a little bit on this. You've got BTC, that's now below both your previous all-time high and your trend line here we've been watching pretty carefully. And very interesting reaction. This must be getting led by AI or some of the Magnificent Sevens. So, yep, NVIDIA's up 1% on this report. Remember, companies like NVIDIA, Meta, and Google, they don't really care if interest rates stay higher for longer. They have plenty of cash, and they make so much money on the cash that it doesn't matter. Interest rates staying higher for longer, if anything, just benefits them. And it hurts their competition, the smaller startups. So they kind of enjoy these higher interest rates. Let's listen in.
Industrial financials, I think earnings are going to come in really good in those sectors.
Becky, we went into this number with a probability of a June cut at 65% to underscore what Stephanie just said. Now down to 57, not as low as the contract has been on a probability basis.
Yeah, it was below 50.
And then sort of going on with what other was saying, but we not to get a rate cut anytime soon. July actually also dropped. I don't like looking that far out into the universe here, but it's dropped. And based on one number, but it's dropped down to 74%. So I like to say a number is more in play and when it has a 60s in front of it, but they're still feeling pretty good about July, but not so good about June.
Stephanie Kelton, very quickly before you go, we were with Michelle Girard earlier, and she pointed out that there's a CPI number coming next week that may be more important on this. I'm sorry, CPI next week that might be more important. What do you need to see there?
Well, we'd like to see continued progress. I think, this idea that we've got a couple of bumps in the road, January, February, would be really nice not to have another bump.
Yeah, I'm going to pull off this for a moment. This bumps on the road argument is actually important. In fact, Bloomberg Intelligence, and they have an interest rate economist, and he just came out and said the Fed hasn't started cuts with the economy improving. He says, since the 1970s, the Federal Reserve has never started interest rate cuts while economic momentum accelerated, and only once began cuts when the ISM manufacturing index was above 50. Now that's interesting because we covered that ISM report. I want to say it was 2 days ago. We were looking at that and we're going, nah, I don't know. Keep in mind, I've had this base case now probably for since about that January, February data started coming in. I've been leaning towards a September cut. I was really blown away that when Jay Powell had his FOMC meeting, he kind of just like brushed off January, February. Because really, on one hand, they're like, oh yeah, we're data dependent. And on the other hand, they're like, JK, that data doesn't matter. So it's kind of funny. But anyway, so this these interest rate folks, they tend to be a really interesting bunch because, pun intended, they sort of guide the rest of the market in terms of, all right, what should we be thinking about this? And then when they guide the rest of the market into, yeah, it's not good, like you got to push back rate cuts, what you're going to find is those bonds get sold off more. Non-interest rate sensitive stocks do well, and then interest rate sensitive stocks potentially do not as well. But anyway, so I'm going to write this down. Historical for Fed. So since, let's see here, since the 1970s, I'm throwing this up on eHack, the Fed has never started cutting interest rates while economic momentum accelerated. It only began once. Fed only cut once when ISM manufacturing was above 50. And never when it was above 50 and at a peak, at a one-year peak. And never above 50 at one-year peak. Okay? Worth noting that today's jobs report signals acceleration, right? Today's jobs report is an accelerating report. We got, again, 303,000 jobs versus the 214K expected. So that gives us a beat. 303 minus 214 gives us a beat of the 89,000. We had a revision down to 5K, so that's an 84K beat, including negative 5K revision. That's a nominal revision as well. Unemployment rate down. The Fed's been thinking that this is going to be going up, and instead of going up, it's actually going down. The last summary of economic projections, we should look. FOMC's summary of economic projections. Let's see here. This was the March release. We'll be able to see their unemployment forecast. And unemployment rate, yeah, see, look at that. They thought by the end of 2024, the unemployment rate would move up to 4% versus a 4.1% long-run unemployment rate. Well, we're going in the opposite direction. So Fed March FOMC forecast 4.0% end of 2024. And then, of course, we had even the household survey. This was like the one thing a lot of rate cut folks were really betting on. They're like, hey, man, you got to pay attention to the household survey. Household survey exploded, 468K. Rate cut proponents were using the household survey to suggest the Fed was late. Can't use that in this report. And then, of course, the wage gains, we did have a revision up. Wage gains for Feb revised up from 0.1 to 0.2, and then at expectation, wage gains for March, 0.3. Obviously, this is going to put weight. And this is the interesting thing about this market is now what's going to happen is people are going to go, okay, economy's still hot. How's CPI next month? So it kind of, or rather next week. This sort of kicks the can down the road. And this is sort of this interesting issue that we have with today's report is it's kind of like, it's like the trial stab wound. It's like somebody grabbed you by the neck and then I just like stabbed you in the side a little bit, like a quick little flesh wound. And then you're like, that wasn't that bad. And it's like, you ready for next week? It's like, oh. so you're like, you're still being held, you're hostage. But I can't say that this report this is not recessionary at all. This is nowhere close to recessionary. And one of the big fears, at least in some of the Fed speakers yesterday, were that, hey, like, if the jobs report comes in weak, we'll be able to cut rapidly. This was something that multiple of them said yesterday. So I'm going to write that down. Yesterday, multiple Fed members suggested on weak jobs, we could cut rapidly. However, we also got Kashkari, who said stronger data suggests we might not need to cut at all in 2024. I'm still leaning towards 1 to 2 cuts myself, but that is a possibility that we just get 0 cuts this year. Obviously, it's going to be driven by the longer-term data. Weird that we kind of missed the January, February, but okay, that's fine, Jay Powell. And remember, I legitimately think Jerome Powell wants to cut rates because he realizes that there is pain in certain segments. It is harder for poorer people with lower incomes and higher debt to actually get ahead. I think it's like the wealth gap is just going to expand because of the way this sort of Ponzi is set up. And you just have to know the rules of the game and know that some of it is just designed to screw people, and it sucks, and it's always disproportionately poorer folks. You know, I was reading this study yesterday that suggests in poorer zip codes, you're way more likely to play the lottery because it's like, how else are you going to get out? You know, it's like sad. But anyway, let's focus on what the suits are saying on jobs before I start going off on the Fed. But anyway, I guess rapidly to wrap that up, Jay Powell wants to be able to cut rates because he wants everybody to win. But you can't. And so then you keep rates higher and then only wealthy companies and people win. It sucks. Anyway, let's listen in here for a moment.
Stubbornly high. But by the way, Steve Cohen
Well,
said it too today.
certainly, I think that the idea, what's the rush? My former colleague, Chris Waller, that was the title of his speech at one point. What's the rush?
How'd they get a Fed guy already? This guy's already left the Fed, but let's hear what he says.
As much of urgency to get a lower policy rate, but still, they're too high by most metrics. If you think the policy rate was at the right level last July when they made their last rate increase, why do you think that level is still the right level today? And core PC inflation is 200 basis points lower. You got to take that on board and bring the policy rate down. But there are other considerations because it's the first policy move, and you don't want to move on news where inflation's moving in the wrong direction. Or so I think that's the trade-off here right now.
Okay, but as you know, we are in an election year, and there's always been a view that as you get closer to the election, that there might be some hesitation about making any moves, frankly.
Yeah, I think you can make 25 basis point moves or anything that's, rationalized by the data that as is coming in. I don't think that 25 basis points one way or the other changes election outcomes. The median voter isn't watching this program. I don't think so. I don't think you can win an election based on whether the Fed zigs or zags, unless they did something extraordinary. But ordinary monetary policy would not affect the election. And I don't think that the committee really takes election into account because of that.
When you look at these numbers, though, how would you grade our economy?
I actually kind of disagree with that because the first 25 signals the start to rate cuts. And people will pay attention to that. They won't know that it's only 25 BP. They'll be going, oh, okay, started rate cuts. So I actually disagree with Bullard on that.
Feelings about the economy seem to be.
Yeah, I read that piece, and I have my own response to this. I think a chart I saw anyway, I'm going to probably get the numbers a little bit wrong, but average hourly earnings have come up over the last couple of years about 13%, but inflation or the price level over the last couple of years come up 18%.
Okay.
So a typical worker is looking at that and they're saying, hey, I'm down 5% over the last couple of years. They don't like that. That's real income down for them. Unless they have some other source of income somewhere else, they're worse off, and they're reporting that dutifully saying in surveys, I think I'm worse off, and I don't like it.
Yep.
So how would you grade our economy then?
On traditional measures like growth, it's really great to see the good growth. It's great to see these jobs coming back. I would mention one thing about jobs for viewers here is that non-farm payrolls haven't really returned to the trend line that you would have drawn from before the pandemic. So maybe it's not that surprising that you're still adding quite a few workers here. If you think the pandemic was this, very large but ultimately temporary disturbance, you should be able to get back to that trend line. That hasn't happened yet. So it's great to see the jobs being added. It's great to see the growth. I think there is plenty of innovation going on in the economy. So from the traditional macro measures, I do think it's a good economy, but this inflation has hurt especially low and moderate income households harder than the rest of the income distribution.
So, but now that you're an academic, we got Purdue University behind you here. I want a grade. I need a grade, not on a curve.
It's a B+.
B+. Okay, we'll take it. Jim, thank you for joining us this morning. We appreciate it.
Yeah, something to keep in mind as well, when the labor force participation rate goes up, what you're actually finding is you could potentially add more jobs without runaway inflationary figures, because by the virtue of the participation rate going up, you have more people available for those jobs. So you potentially create less wage pressures. It's a good thing. Oh, look, it's Mohammed. This guy basically lives at Doomberg.
Continuously overly data dependent, then maybe we don't get cuts. But I'm hoping that they will see through the backward-looking data and look forward. And I think we will end up with 2 cuts this year. It may not start as early as a lot of people thought initially, but I do think we will get 2 cuts.
Mohammed, this was great. Thanks for making time for us today. We appreciate it. as you often do on Payrolls Friday.
Thanks for making time for us. He's like on their salary, isn't he? Anyway, I'm pretty sure he's a paid contributor over there at Doomberg. He's like always the first one they call. Anyway, so interesting. He thinks 2 rate cuts and later than expected. But what's also worth noting is that 303,000 increase. I'm going to write this down. This was very interesting. This beat every one of the 74 economists surveyed by Bloomberg. Not a single estimate came in that high.
Thank you. News of the weekend. There you go. 35 minutes away from the opening bell. Equity futures positive by 0.4%. It's another rock-solid jobs report, a big upside surprise. The source of the strength, we could debate it all day. It's not coming with runaway inflation. What does that mean for this market? Stocks are higher. The bond market's hanging in there. Yields approaching the highs of the year, close to 440 again on a US 10-year. To debate it on Monday morning, Jeff Yu of BNY Mellon, Laura Rain of FS Investments, Jimmy Chang of the Rockefeller Global Family Office.
Yeah, you know, a zero hedge, they usually have a bearish tilt. You know me, I try to just wear my heart on my sleeve and just be very transparent with sort of where my biases are. I don't have any real option plays or any kind of like plays on this jobs report. It doesn't really matter. Whatever. I have a hard time kind of gambling on like reports or like kind of like earnings. I like seeing trends and then trading off those. It's kind of like yesterday. You know, we did a great trade and pulled off like $8,000 to $9,000 of gains on you know, relative to that, not horribly much risk. And so that was great. That was wonderful. And you know, those are always the alerts I send to everyone in the Stocks and Psychology Money Group. Get in before tonight because we have a price increase coming tonight. That was supposed to be the Easter Sunday price increase, but we did delay that a little bit. Mostly because we had nobody responding to emails at staff@meetkevin.com for people wanting to bundle up between the event and the courses. But anyway, Zero Hedge has a little bit of a bias towards the bearish side and sometimes I would say the more skeptical side. And so they put together this chart. Here, I'll just throw it up on ehack.com. This is in my editor, so I know it looks a little weird. Not that my editor is really particularly fancy. I threw this website together in like 5 minutes, but it's the content on it that matters. You know how many people, by the way, get mad at me about ehack.com? It's like when you go to ehack.com, it's like just one giant scrolling page. You know what drives people nuts about it is that they're like, wait a minute, Kevin, I can't click on the individual stories. So I added little anchor text and for it. They're like, but I'm so used to like being able to click on individual stories and expanding the story. I go, why? You know why they do that, right? They do that for clicks so they could show more ads. Because you load in one set of ads, then you click on a story and you load in the next set of ads. But it's not actually intuitive to have to click 30 frickin' times to read the news. So I don't really care about, there are no ads on this. I don't care about SEO. Skip Google. You want to go to ehack.com, go there. You don't? I don't care. It's a resource for me. But I thought that was very interesting. But anyway, so Zero Hedge, I'll just make a little note here that they tend to lean, Zero Hedge leans either skeptical or bearish, or maybe I would call it more, like libertarian. That's probably the way I'd put them. But anyway, they point out here that government employment came in at the second highest increase since the start of 2023. Yeah, I'd be curious to see what it was right before that. I wouldn't be surprised if it was up higher. But anyway, I don't know that this really matters because we did beat by 89,000, and even if you take the 5K revision off, we beat by 84K. So, you know, just the beat alone more than offsets this. So I'll write this off. The beat alone, net of revision, more than offsets all government employment. Not sure this is an indicator itself. That's just sort of my opinion. But, you know, I do like to sort of respond to some of the things that we see out there. Okay, good. So, all right, let's see here. Okie dokie then. So, portfolio manager at JP Morgan. If services inflation shows signs of picking up in CPI and PCE, the Fed's patience might run thin. Okay, that's interesting. So JPM argues this is going to put more pressure. So this is more pressure on Fed patience if PCE and CPI inflation services specifically, so Supercore. Remember, that next report is on the 10th, which is Wednesday. Come in hot, then higher rates might be here to stay. Risk assets ignored the rates moves until this week. But if the economy is staying too hot, the question of Fed cuts and the specter of Fed hikes could come back to the market. Ah, okay. So far, market ignored Jan-Feb, but it can't ignore higher data forever. It's basically what they're saying. So now that's also really interesting because I am watching BTC as a risk asset. I don't see it as much of an inflation hedge as I see it as a risk asset. And so when risk and FOMO runs rampant, we generally see Bitcoin run to new all-time highs. And we have been in this consolidation pattern, quite frankly, for nearly a month now. We're at about 3.5 weeks in this, about 3 weeks in this consolidation here. And we're having trouble staying above support at 69K. We're below that now. We're having trouble staying above this trend line, although this trend line will increasingly make it more difficult since it is a rising trend line. We keep falling below this. So we're watching these. Okay. Yeah, how about the 10-year? Yeah, it doesn't matter if you think that, you know, I see a comment here. Somebody's like, Bitcoin is real money. I don't really care what you call it. In the short term, it trades like a risk asset. You know, you can say, well, it's not fake money. I don't disagree with you. That doesn't change the fact that it trades like a risk asset. It's not an insult to Bitcoin. It is what it is. Wake up. Take the stick out of your booty. You know, not trying to insult your coin. So, Bloomberg Intelligence, let's see what else. Of course, there will be some forecasts showing slowing in the second half, which could give cover to the Fed to cut. But economic momentum isn't slowing enough right now to justify bearish action. Okay, so let's write that down. Intelligence, economic momentum not showing softening to justify dovish action. Got it. Let's see here. It's an election year, so the numbers will be trumpeted by the White House. Yeah, no doubt. Although, we'll see revisions on these again. Although, last month's revisions were really nominal. You know, 5K. It's nothing. You wonder if some economists will be tempted to put off their first rate cut projections at this point. We do have a March CPI report coming up Wednesday. That's true. Apollo is sticking to its view that there will be no rate cuts. So, Apollo, I like these kind of market reactions. I think it's kind of interesting. That way you're not just getting me, Kevin's opinion, you know. Bitcoin is simply a hedge against reckless monetary policy. Yeah, I don't disagree with that. It could be, but then again, you know, that implies that it's an inflation hedge, and I'm not convinced that's the best short-term trade. Long-term, that might make sense. But remember, when inflation was skyrocketing, Bitcoin was crashing. So at least in the short term, and by short term, that was like almost a year long, that wasn't true. Although we did have some other problems in the crypto space. You know, the disaster of regulation that came a year later than expected, FTX, you know, fraud, all this disaster. Okay, who's this? Principal Asset Management. At first sight, the jobs report leans against 3 rate cuts, yet the average hourly earnings figures are in line with expectations. That is true. Powell made it clear in recent speeches a strong labor market is not a concern if price pressures are moderating. That's fair, but I don't know that you could say price pressures are moderating on this. So I'm going to write down Apollo sticks with 0 rate cuts. And it is an interesting argument, this person, though. So this is Principal Asset Management. J. Powell Powell says strong jobs reports okay as long as wages don't take off unsustainably. That's true. Again, I'm going to write that down. True, but remember the Fed's target. Do you know what the Fed's target for wages is? The Fed's target for wages is 3%. That doesn't mean we have to be there today or tomorrow, right? It's just eventually we have to get to 3%. At 0.3%, we're at 3.6% annualized. And we did have that prior revision up. Okay, JPM, services. Okay, that's the services one. CIBC Capital Markets sees immigration playing a role. Yeah, duh. Let's see here. And, oh, interesting. The January revisions, by the way, actually came in positive 27K. Note, January revisions came in up 27,000 jobs versus the usual down. See, we usually get down. That's also interesting. This feels like one of the first times we've actually gotten up revisions. Mostly because everybody generally makes fun of the White House because they're like, oh yeah, okay, strong jobs report, and then it just gets revised away. Well, we just had a revision up. That's January. That got revised up from 229 to 256. So January just got even hotter. That's interesting. Let me write that down. This makes January hotter. This makes January even hotter at 256K jobs. Okay, interesting. Yes, we know the participation rate went up. This is true. Let's see here. An ETF could buy billions in BTC, then mark a certain amount that it would buy, 10% or sell 10% of price fluctuation. You use that money. I don't know. Somebody here is yapping about how ETFs work. Anyway, one of the things that I think is cool about ETFs is if you were in BTC, you could allocate to BTC in an ETF, and then if you got a lot of gains, you could sell that, basically exchange it for, like, let's say Ethereum at some point in the future, or another stock or a money market fund without paying taxes. The ETF vehicle's really, really interesting. Anyway, so, okay, good. So let's get a little bit more insight here from Doomberg, CNBC. Then we're going to obviously watch the market open to see how the reaction is in the actual market open. Right now, it does seem like, the Qs are mostly positive. You've got NVIDIA was up over 1%. Now it's sitting up about 0.75%. Again, these are companies that don't really care about whether or not we get rate cuts. In fact, they probably benefit from rates staying higher for longer to some extent. And then, of course, remember that tonight the price goes up on the Stocks and Psych group. So as I send those buy-sell alerts like that, over $8,000 profit yesterday, we will, and that wasn't a big trade either, we will make sure to keep sending those alerts. If you want to be part of Stocks and Psych, not only do you get the trade alerts, but you also get the lifetime access to the course member live streams. So Q&A, we've been doing that for like 6 years already. Actually, I think we're at like 7 years of doing course member live streams. So I don't expect we're going to be going anywhere. I love starting my days with the live streams. Anyway, let's listen in here.
Market. Listen, I mean, it'll be interesting to watch at the end of the day in terms of how we go into the weekend, because when you've got news swirling, long end interest rates don't do a lot today given the nature of the curve. I've talked about
JJ here says zero company benefit from interest rate, bro. I think you're wrong, because if you look at a company like Microsoft, they're actually making about 2 times as much interest on their cash as they're spending on their debt. So you're making almost $1 billion in interest on cash, and you're spending about $500 million on debt. So cash-rich companies absolutely benefit from higher interest rates. It's simple. Who gets screwed? Well, people with less cash. So retail investors, poor people, small businesses. Small businesses get frickin' reamed in a high interest rate environment because they're usually the equivalent of a poorer individual. And so it's not a surprise to me that the Qs are up and the IWM in the pre-market is down. IWM's down 64 bips on this. Yeah, no poop. So you know, that's I think you're wrong to say that higher rates are not good to the larger companies.
For sure. But gosh, we've been able to continue to buy call options with volatility under 10 on the index on the S&P 500.
Hey, Bruno, it should automatically apply the coupon code when you go there. Thanks for asking what it is, but it should automatically apply. Let me see. We made that a little easier so people didn't have to type it in. But yeah, if you click on it, I want to say if you just go, get me lifetime access, fill this in. I don't know, pick one to fill in, go to order form. And then it should auto-apply. Yeah, it does. Spring. Spring is the current coupon code.
So we moved 100 handles yesterday, so 3%-ish, a little less than 3%. I don't know. That's pretty good. If you're not paying for the volatility and you can move your position around relative to it, I think equity volatility is really, really attractive.
James is wondering if I'm bullish or bearish on this report. I'm probably honestly like 55-45 on this report, where I'm like 55, I would call it hawkish, and 45 dovish. Like, you know, I'd lean a little hawkish on this because we did get a tick up in, we got a revision up on that week wages report last month. And it's obviously a report that says you don't need to be, like, rapidly cutting. So, you know, the need for rapid rate cuts is gone with this report, and you're still getting some wage pressure that we don't know if that's going to get worse. So to me, it doesn't signal, oh yeah, I need to be really, really dovish on this report. I think that's why I think it leans slightly hawkish, but it's not a very clear report in either way that you look at it. Benjamin just donated $5 to tell me that Bitcoin isn't a risk asset. Okay.
So, listen.
Thank you.
You have to assume the terminal rate's a bit higher. You know, is it 3-ish? Is it you know, around that zone? I think we're going to learn a lot in the next couple of years. And I've said,
do any of my option trades involve 0 days? Yes. My favorite day to do 0 days is on Fridays, actually, because they're really cheap.
And I'd rather make the decisions for what's going to happen in the next 12 months.
You know, yesterday you could have gone with a 0 day on a SPY short. You could have spent $100 and turned it into $8,000. It was crazy. But then again, that sell-off yesterday was insane.
On the fiscal trajectory for the U.S. Rick, good to have you with me. Rick Reader there on the reaction to the jobs report. If you're just tuning in at 9:12, where have you been?
Andrew wants to know if I'll release a class on how to write backwards. No, because I don't actually know how to write backwards.
Higher, Manis, on that hot jobs report. We do have tech stocks in particular staying higher, including Netflix up 1.2%. This, of course, also as Pivotal has moved its price target to a street high of $765, suggesting 20% upside. Shockwave Medical up 1.7%. J&J is buying the medical device company for $13 billion. And then Tesla not joining in on the tech party. This on news that they're offering steep discounts on SUVs, piling up on big inventory. Manis.
Abby, thank you very much. Coming up, payrolls Friday. We get the reaction from the White House. Anne-Marie Jourdain sitting into the seat. She'll catch up with the acting Labour Secretary, Julie Su, in just a moment. That conversation not to be missed on Bloomberg.
Yeah, somebody here is like, they made some money on a short on Tesla. I had a short on Tesla yesterday as well. I opened it at 4%. Again, the net on yesterday was pretty positive, so it's fun. But okay, let's go to CNBC here for a moment. But I could have played the Tesla short a little better. I wish I held it for a bit longer. So sometimes the woulda, coulda, shoulda though in trading, you always have to be careful about that. I always caution people from doing that. Like, oh, if I had done this, I could have. Now, if there's a learning opportunity, like if you missed a technical signal, that's great. Like, learn from it. But if it's just woulda, coulda, shoulda, you have to be really careful because otherwise you just kind of go mad. And then you kind of do like you fall victim to the Call of Duty problem. The Call of Duty problem is when you're like so pissed that like somebody killed you in the game that you'll do everything to just go get that one person. and you go get that one person, you just end up getting killed like 20 different times on your way to just get that one person. So, this is sort of the gambler's fallacy, they call it, right? It's emotional, right? So you have to be really careful with trading. Like it's nice to be able to say, I didn't make the trade, move on. Look for your next idea. But getting married to like, it should happen, it's a great way to lose money. Okay, so Nick T just tweeted a little more. Oh, Nick T. What is this? PSA, average hourly earnings could look firm on a month-over-month basis in March, which had 10 weekend days versus 8 in February. Oh, that's dovish. Calendar effects aren't always accounted for by employers when they report wages, which tends to boost the average hourly earnings. That's dovish. So I'm gonna write that down. Nick T. Dovish responds to wages. He says, again, 10 weekend days in March versus 8 in February, which could boost average hourly earnings. Okay. Average hourly earnings, and then the chart of average hourly earnings. I think this is a good one to look at. This is a chart of the average hourly earnings right here. It shows them trending down. The question is this enough of a downtrend? Or are we somewhat getting stuck? Do we need to start kind of rotating, down more to satisfy the Fed? Who knows?
He's tougher than it looks. The index funds, I thought, were going to roll and go with ISS and go with Peltz, but I think Ira was incredibly persuasive. Very, very rigorous guy in the end. Now we need the stock higher.
I was going to say, almost got to 120-ish. Can you separate the decline from the tape yesterday?
Yeah, look, I mean, it was flirting with 120, 121, and I think people felt that my interview with Nelson, it didn't sound like he was dumping the stock. Now, last time we had this and he got out, it was on the show, boom, sold a lot. Now, there's always...
Okay, boring, Jim. So quickly, 10-year is up 8.1 basis points now. Gold is up over 23.08, and Brent is over 91. It's taken so long for Doomberg to come up. Did I mess this up? Must have screwed it up. Whatever. Okay, we got C and Sizzle. I'll figure it out. They're being boring. Whoops. All right. It's all right. Oh, here we go.
Expected, not just this month, but over the last several months.
Jay Powell talked about this earlier this week.
Oh, Labor Secretary. Well, of course, they're just going to be cheering this. Let's see what they say about Jay Powell, though.
Of how he sees it, which is more immigration, creating a bigger economy with more capacity instead of a tighter economy. Is that what you see, a growing economy, maybe because of this influx of immigration?
Well, so we continue to see this tight labor market, in part because we're seeing growth in jobs and labor force participation rate high, right? But to your point, immigrants have long contributed to a strong economy. And so this overall high GDP, yes, is a function both of, again, immigration and immigrant participation in the workforce and overall participation. These unemployment rates being at historic lows are true pretty much across the board.
One area where we didn't see any improvement was manufacturing employment after a drop last month. We spoke about this last month where there's a loss of 10,000 jobs in February. The president likes to talk about boosts in manufacturing space. Why are we not seeing more of that?
Yeah, that's right. So we've seen about, over 700,000 jobs in manufacturing created since the president came into office. This last month, we saw one of the industries of large growth was in construction, especially specialty construction. So these are carpenters, these are electricians. And so there's building going on. And you gotta, build the factories before you have people working in them. And so we've seen steady growth, but the manufacturing kind of follows the construction, and this is a moment of historic investments as part of the president.
All right, so yeah, really talk up that economy. Somebody here is wondering why I didn't mention a $4.50 price target for EPS target for 2027. Well, I just looked, And $4.50 isn't mentioned once in this. So I go in here and I put $4.50 in. I get no response at all. When I put 2027 in, I don't know if this is what's confusing. It's this 42 times. I mean, I guess you could divide this out, right? We iterate. Is that what you're doing? But let me see here, because I'm trying to figure this out. 189 is their price target divided by 42. That's why we were getting it, 4.5. Oh, that is interesting. So yeah, I guess I guess one of the ways to look at that is that's based on 42 times their EPS. So that would put you at about a 2.1 peg. That is actually interesting. So otherwise, $4.50 isn't mentioned in here at all. So what I did with the 20% growth target is suggesting that they see for Tesla an EPS of $1.80 for 2024, and then they raise that to $2.15 for 2025. So what you're saying is, or I guess what you're highlighting, is that Deutsche Bank's EPS targets for Tesla are 180, 215, and then you're going to get to 450 in 2027. So let's write that all down. In 2025, that means we have an X number there in 2026. Now, what's interesting about that is that would imply a larger growth rate on EPS, because Wall Street is forecasting 20%. That's where I got the 20% from. Wall Street's forecasting 20% right now, if we get 20%. So if you go 1.8, you actually probably have to grow that by about 30% to get to 4.5. Let's go with 1.8 times 1.3 times 1.3 times 1.3. No, you have to have even more. You have to get to about 40% EPS growth rate. No, maybe 35. Yeah. So, yeah, that's about a 35 to 36% growth rate. So let's write that down. That is an interesting catch. So if I go here, so if we go 189 divided by 42 does equal 4.5. This implies a 36% growth rate from 2024 EPS. Now that is interesting, because then you go 42, this is a very future peg, right? 42 divided by 36, that would give you a future peg, is a 2027 peg ratio. I don't usually like to go ahead that far. That gives you a 27 peg of, what is that? 42 divided by 36. That gives you a peg of 1.16, but that's a very far out peg. So to use their growth rate, it would actually give you a peg today of 180 for 2024. So we would be at, what's the stock? 170 or something like that? Yeah, call it 170 divided by $1.80. You're at 94 as a PE ratio today. 94 divided by 36. That puts you at a 2.6 peg today. So 36% growth equals 2.6 peg today. So that is interesting that they're suggesting a 2026 and 2025 acceleration, 2026 and 2027 acceleration. I'm guessing likely due to a Model 2. So this is trying to look quite far out. So that's interesting. I think that's a good catch. I appreciate that, JR. I like that. That's good. We'll update that in. All right, let's keep listening here. What do they have to say?
That's on Bloomberg.
Nothing. Okay, they're playing the song. All right, let's move over. All right, keep going here. Listen in over here.
Conventional wisdom, but he's willing to tell the truth, which is that Gelsinger is just simply one of the most suboptimal CEOs we've seen in some time.
Is he on the wall?
Yeah.
He is?
Yeah, I got to put him on the wall.
Really?
Yeah, I think I have to. I mean, this is an extraordinary moment where they just stopped caring after making incredible claims. And I've been back and forth on them. I don't know what to say. This Stacey piece is this may be the last nail. I don't know what to say. I read this piece and I said, I read it 3 times. I said, no. I mean, those things are what an executive should never be doing. And it's got the whole litany. I think we have to break out the wall. I mean, maybe this weekend I'll talk it over with my wife because she says you got to be a little more upbeat, Jim. People are getting. But last night I'm serving drinks and I have my NVIDIA hat on.
Okay, boring. So I updated that at the bottom of today's piece on eHack. So I like that, JR. That was good. That was good. Okay, so yeah, I just didn't divide out that number to get their growth rate, and that's a good catch. Okay, what is this? Tesla is now offering. Let's see here. Are these new discounts? No. Tesla slashing prices. I don't think these are new price cuts. There's just an article on this in Bloomberg, or I should say Doomberg. Tesla slashing prices of its best vehicle in a bid to clear the biggest stockpile ever. The company is marking down Model Y sports utility vehicles it has in inventory, with the rear-wheel drive version going for $4,600 less than the cost to custom order a sports utility vehicle. See, now that's actually something that we made a video on a few days ago. Hey, maybe they saw my video. I'm not trying to pat myself on the back, but we did cover that a few days ago. A few days ago, we did say it's weird to me that you could get a model match used for like a whole chunk, or sorry, not necessarily used, new. It was new in inventory for less than, configuring a new one. Let's do that live again really quickly right now before the bell. And I think that's what you want to pay attention to because it's less visible than price cuts, right? So let's do this really quick. Purchase price, let's go with the Model Y rear wheel drive. We'll go black, 19-inch wheels, 5-seat. We're not going to add any of the autopilots, okay? So this is your base model rear wheel drive. After the tax credit, you're at $37,490. Okay, great. So let's now go and see if we can get inventory. Well, look at that. Available now. Look at that. You don't even have to go far. They literally tell you, hey, you know what? If you take the limited inventory available now car, we will give you an additional $2,700 off the price if you just grab the available now one. Okay, so that's interesting. So that's, let's write this down really quickly before the bell here. So we're at $44,990 custom black 5-seat no AP rear wheel drive. $42,290 discounted if you take existing. Okay, now I wonder if I can actually go to, there should be a way to look at the inventory. If I just go to Model Y inventory, now I'm gonna go for Model Y. Let's go for the rear wheel drive, black, 19-inch wheels, 5-seat, no AP, no autopilot. And then, yeah, here we could see various different versions, but nothing's lower than what they show on that page. There's nothing under that 42 level. It's sort of up from that 42 level. Okay, interesting. So that is where they're going to show the biggest discount right now, is they are going to show it as you go to try to check out. I wonder if they're doing that on Model 3s as well. Like, let's do a Model 3 Long, for example. Let's go with a Model 3 Long. That is going to be a purchase price of $47,740. As is, $47,740. Nope, they don't actually let me do that with the. They don't pop that up. They only show that for the Model Y. That's interesting. Very interesting. All right, very well. So we're now about a minute away from the bell.
Jensen Wong from NVIDIA told me is that J&J wants to own the operating room. And this is perfect for J&J. They are filled with AI. It's a very good move if you want to own the operating room, because these guys bust basically heart arteries going into the heart. It's an exciting bit of technology. At the same time, J&J stock has been a horror show, and this will not help. People are just going to say, well, what are they doing? And they haven't been able to clean up the lawsuits with talc. And now
all right, let's get ready for the bell. Let's get that music going. Who are you gonna call? What are they gonna say? What is the market gonna say today? What is their answer gonna be today on Who Wants to Be a Millionaire? This is creepy. I love it though. I love it. I'm excited for this. So going into this, we got about 10 seconds to go. Tesla's down about 1.2. Let's listen in. Here we go.
listing anniversary. And in the NASDAQ, it's Mexican hotel developer Milano Global Investments. Recent listing via SPAC. Levi, we talked about earlier in the week.
This was a remarkable quarter. Now, somebody come on our network, I'm not going to mention names, recommending shorting the stock. It was one of the worst calls ever because I didn't realize that there are denim cycles. And right now we are in a denim cycle for not.
So was the correct answer red or green? That's a 50-50. We're going to have to take a 50-50 on this one. We're going to go through all our lifelines today. All right, there's Tesla dropping below the 170 daily support line. My yellow support lines are daily, so they're not as robust as the blue lines that I like to throw up. We've got BTC trying to get back to 6,700. You've got Google's trying to go positive here. ARM's up 70 bips. You've got the Qs sitting at about 36. Unclear what direction they want to go. Although it does look like your AI chip plays, Meta, they don't give a flying F about interest rates. But you can see the interest rate sensitive. Look at that perfect bounce on end phase right back to 113. Yesterday we talked about this maybe going back to 119 by the close. It basically did. Look at it ride that 119.88. And it did end up in pre-market going right down to our 113 level. This was not the best report for the interest rate sensitives since it did move back that Fed rate target to September for the first 100% chance of getting a rate cut. It's like 90+%. We did also fall on our chance of getting a rate cut in June to about 53.4%. That's about the lowest we've seen in about the last week. And I think, unfortunately, we're probably going to continue to unprice that June rate cut. Tesla's trying to go push that green candle right now, see if it can get back up to 170. NVIDIA, again, don't give an F. Buy the dip on NVIDIA is apparently the name of the game. Although, remember, you're at 870. You've really been bobbing around in this channel here. They really haven't gone anywhere between 850 and 970. Pushing more green candles on Tesla. Enphase is not. It's trying to. Qs are pushing up. Here we go. This is going to drive us maybe positive into the CPI report. Next CPI report is, of course, Wednesday. Mark your calendar for those deadlines. So today we had jobs. Then I'll read off some other ones. The next catalyst is, I mean, on the 8th, you do have New York Fed inflation expectations, but nobody's going to pay attention to that. You do have the warrant expiration for House Hack. Go watch more updates on the House Hack YouTube channel at House Hack Homes. It's linked down below, or just type in House Hack Homes or go to househack.com. That expires on Monday, so if you don't wire in, you lose your warrants. CPI is Wednesday. That'll be the big deal. But then we'll follow that immediately with PPI the very next day. And then next Friday, we'll get import-export prices and sentiment, as well as inflation expectations from the University of Michigan. So next week's a pseudo-busy week. And I think this mostly neutral jobs report today kind of just kicked the can down the road to next week. Okay, let's see here. We've got the Make America Great Again PAC supporting Donald Trump, really, focuses on the number of multiple job holders increasing 2.7% last month and 27% since Trump left office. That's an interesting line. So the Make America Great Again PAC. So obviously there's a little bit of bias here, but that's okay. Everybody's got some. Multiple job holders up 2.7% last month and up 27% since Trump left office. That's interesting. I hadn't actually seen that that sort of statistic of sort of measuring back to January of 2021. Boy, that was a crazy time. Anyway, Morgan Stanley is sticking with June for their first rate cut. What argument they have? The data point to a non-inflationary expansion of the labor market does not alter the Fed's rate course in June. Okay, so Morgan Stanley, this is, we'll call this a non-inflationary wage expansion does not alter June cut. Okay, that is Morgan Stanley's take. Good thing they're always right. I'm just kidding. Sorry. Shout out to Morgan. Where is he? Where's Mike Wilson? I said I'd love to interview him. You know, I actually think he's got a brilliant head on his shoulders, and it just got caught on the wrong foot last year. But that's okay. Everybody makes mistakes. Reports suggest inflation is easing. Wage growth ticked down from 4.3 to 4.1 year over year, maybe consistent with the Fed's inflation target. Well, it's not. It needs to get down to 3%. Fed may see this as a Goldilocks report, says ZipRecruiter's chief economist. Oh, okay. ZipRecruiter has an economist? I guess that's interesting. It'll provide some data maybe to employers. Yeah, Tesla didn't like this. Yeah, still going down here. You've got BTC did push over 67. That's nice. ARM's pushing red candlesticks now. So is Nvidia. So is Meta. Tesla is pushing red candlesticks. The Qs are pushing red candlesticks. Enphase actually pushed up a little bit off that 113. You got to trust the lines. You got to trust the lines. Don't give up the lines. Somebody here says Tom Lee is sticking with 3 rate cuts. You mean Mr. Bullish is sticking with 3 rate cuts? Of course he is. And then you write, been right all year. Bro, the year is 3 months old. Okay. Let's see here. Is the 29% increase a percentage of the workforce? Presumably. Multiple job holders. Yeah, presumably. Well, no, sorry. The nominal level is up 27%. So if you have 100 multiple job holders and now you're at 127, that would be a 27% increase. So that is not a nominal level. No. Okay. Good clarification. I like that. That's good. Fed killing stocks like Enphase. Yeah. I mean, Jay Powell literally said on stage a few days ago, you know, this obviously affects the interest rate sensitive sectors like durables substantially. Yeah. Steve here. Steve spawns in. We've lost 1.8 million full-time jobs in just the last 4 months. Yep. Let's see here. Let's see here. All the jobs go to illegals. Oh, there's a comment. Fear and greed now at 59, 49 last month. Yeah, or yesterday. Yesterday was wild. Yesterday was a very aggressive day. And I don't know if that like violence is going to come back today. I mean, look at the violence here on Enphase. It's like you did just try to push up, and now you're pushing red again. Dell's pushing red. The Qs are trying to go red. They're literally trying to push red right now. Tesla down 1.5. BTC is going to lose 67. ARM just dropped 1%. What happened? ARM just started tanking. Nvidia just started tanking. It's happening again. What the hell? Yesterday was shocking. The sell-off yesterday was shockingly rapid. And volatility spiked like 8 to 14%. It was extreme yesterday. But it looks like you might be getting some of this volatility back. You might go for some calls on the VIX, baby. Because that volatility is, oh yeah. Yep, here it is on the, this is going to be 15 minutes delayed, isn't it? Yeah, I'm just now getting opening volatility. We get it in about a minute. So we haven't actually gotten the VIX to update yet. But with these numbers, these red candlesticks coming in here, look at ARM. It's tanking. And so is Nvidia, and it was just rising. Enphase is now down 6.8%. Holy crap. It's just a straight tank there all of a sudden. Palantir, you know, had some nice green in there. It's trying to turn red. You've got S-Box. I don't know how much they really move on data like this. Matterport, so your small company. How's IWM? They were down 69 bips. Steve says, oh, they're actually only down 25 bips. It's not bad. Steve says, save yourself, buy gold. Steve, you need like a gold referral link, man. You know, it's got to be like gold.com / you know, Peter Schiff. I mean, Steve. SMCI, what's happening with SMCI? Steve Schiff. And Dell, that's true. Okay, so Super microcomputer down 2.5%. IWM is actually not doing that bad, the small caps. I thought the small caps would have done worse. NVIDIA is rotating down. Yeah, this is very interesting because I see the report as neutral, but it's possible that that neutrality of the report could be interpreted by markets as, all right, well, neutral isn't enough to force a cut, right? So maybe you needed more than neutral here. Because again, I was 55-45 on this report. I maintained that. And so seeing sort of the market, now try to dump basically is a sign that maybe there were some higher expectations for some kind of report to like undo some of the strength of January and February. And instead, we actually increased the strength of January and February. Both of them got revised. January job numbers got revised up, and February's wage gains numbers got revised up. So, you didn't really quell the January-February pain. I'm going to write that note down on EHAC. I always think that's very interesting. Kevin thought this is 55% hawkish, 45% dovish. Problem is market likely wants to evidence that Jan, Feb were outliers. This report increased Jan jobs and increased Feb wage gains. So staying neutral does potentially more to reiterate Jan Feb than it does to remove Jan Feb. So hence a slight hawkish tilt. Hence slight hawkish tilt. That's sort of the Meet Kevin bottom line on that one. So that's all up on ehack.com, kind of just a summary of all the numbers in case you're just now catching up. It does look like we're trying to get a little recovery again here. Look at that, getting the bounce. So this could all just be part of the first 15 minutes of volatility. Very normal to see this the first 15 minutes, so we'll see what happens here. But you are getting a little bit of a bounce now. All right, so let's take a peek at what else is being said. Then I'm going to go make another cup of coffee and go to the course member live stream, which, of course, all course members are welcome to join. You get lifetime access. You join those courses. Remember, we get a coupon code expiring tonight. If you want to bundle up with the Vegas event or real estate or anything, email us, staff@meetkevin.com. We'll get you taken care of today. And if you have questions on House Hack, ir@househack.com. But get your email in before noon today because the person who really does a lot of work in the IR email is taking off a little early today. Anyway, bond yields likely to retrace lower as the weekend approaches. Really? Why? Bonds initially reacted bearishly and are now struggling to go lower. Yields are likely to pair earlier gains. Is that true? Let's see. Bonds right now, yeah, you were up as much as 8 basis points. You're up 5.8 right now. You're sitting at 4.367 on the 10-year right now. You've got gold at 23.23. Brent's still over 91. And you do have the indices that are green. The Qs are green. IWM's trying to go green. Dow Jones Industrial's green. The SPY's green. So everything's mostly red on this. NVIDIA is recovering on that bizarre drop we had there for a moment, which makes sense. Again, I said NVIDIA doesn't really care about these higher potential interest rates. Let's try to see what our big movers are today. So big movers to the upside today. We have Krispy Kreme's up 7%. MicroStrategy up 2.7%. Amazon. Let's go Amazon. I got some juicy exposure to Amazon. I never used to, but we recently moved in on there. Remember, if you want to see me make big moves or just really any move, I send all my alerts to the Stocks and Psychology of Money group in the courses link down below. We've got Caterpillar moving up 145, AMD up 194, Palantir 129, and Enphase 5.5 to the downside. Sun runs down, Teladoc's down, Intel down again. Back into the 30s for Intel. Ouch. Rip Intel. Tesla down about, and I started a position in Intel actually like around 28 bucks. But man, taking some of those tendies away right now. It's just like walking up to my plate of chicken tendies and just they keep taking. Every day they take another tendy. I'm like, bro, leave something for daddy. Anyway, Tesla down sitting at about 2% to the downside. Let's take a look at the Qs. Yeah, no, Q's wanting to trend up. SMCI's recovering. Google's recovering. Mexican peso hits new high. Ooh, they're calling this jobs report healthy but not strong. Not too hot for stocks. All right, could see that. And then we've got jobs data suggests traders might see higher R star. Right. Yeah, that is possible. So let's write that down. R star is the neutral rate. Excuse me. Fed neutral rate might be seen slightly higher due to these reports per Bloomberg. All right. And let's see what Bloomberg is up to right now. We got a few minutes left here to kind of cover the movements in the market. Tesla's still rotating down. Let's see what we got here. Is this an ad?
It's like they treat their...
Yeah, it's an ad. Boy, read the teleprompter more, will ya? You know, they really got to work on, like, when they spend all this money on ads, make it not look like people are staring into a teleprompter. Yeah. they need to use the Meet Kevin trick. I usually just ad-lib most of my stuff anyway. So, okay, let's go here. Okay, so end phase can't keep it up. But chips are back on the day. This makes sense, again, for chips to be strong today and for interest rate sensitives to be hurt today. The Amazon move is impressive, especially after the realization that their just walk out stores are kind of not really AI. They're kind of like, 1,000 people from India kind of fact checking. It's like, got it. Snowflake's $1.30. Snowflake's actually had a $20 move here, didn't they? Oh, no, never mind. I thought they were in the 130s. Never mind, they're still at the bottom. Still bottom barrel on Snowflake. Fascinating. Microsoft back over 420. Look at that. This is you're coming up on a big level here. 430 is a big level for Microsoft. And you've kind of been bobbing around here. Not sure where to go on Microsoft. And NVIDIA still up a 1.5. Although it looks like we might be starting to get another consolidation or red candle here. Enphase is almost down 7. Tesla now down 2. Again, likely because of the potential delay of the first rate cut now to September versus the prior expectations of June. We'll see. There's still a 50-50 shot at June, though. All right. Still on ads on Bloomberg? What is this crap? So many freaking ads. By the way, have I ever mentioned that you should get life insurance in as little as 5 minutes? It's what it's what Lauren and I use, and we can Apple and Android pay for it. It's pretty cool. metkevin.com/life. Freaking hate ads.
So
that was a paid promotion, by the way.
Economy, where I think you can see the sort of soft landing that people did not think was possible just a year ago. And there's every reason to think with productivity as high as it's been, with business investment, with growth, with jobs creation, inflation coming down, that the economy can continue expanding, creating jobs and opportunities in a balanced way.
Do you recall any time when we had healthcare adding good jobs, government, construction adding a lot of jobs, leisure and hospitality adding a lot of jobs, social assistance adding a lot, retail? I mean, this is the most balanced.
Yeah, it's pretty broad-based, honestly. Jim's right here.
Yeah, this is a very broad-based, ongoing growth story in the U.S. economy. We're continuing, of course, to seeing investing in America in important areas that will build for the future, like green energy, and in areas like high technology, semiconductors. So the broader picture, as you say, I think is very encouraging.
I wonder, Director, how you're thinking about immigration. The Fed chair did mention it. Goldman has a report out today, 2.5 million immigrants last year, close to a 2-decade high. Obviously, it is helping the labor force, but how do you perceive it when it's so politically loaded right now?
Well, look, we are seeing just a very attractive job market with loads of good opportunities, and that's why we've seen participation increasing
A lot of that's come from people coming off the sidelines back into the labor market because wages have been...
the border sidelines? Okay, kid.
We've also seen a lot of people moving between sectors for good opportunities. We're doing a lot of investing in good jobs, in apprenticeships, in pathways to the middle class that are inclusive of but don't require a 4-year degree. And so there are good opportunities, of course. Immigration.
Kelvin here in the chat says, thanks for the Enphase trade update, trade yesterday. You got it, man. You got it, bro. Stay tuned for more alerts. See what we can pull off. Yeah, it'll be fun. So that's all in the Stocks and Psych group linked below. Okay, so yeah, next up, what do we have? We have the Qs keep rising right now. So you might end up having green going into the CPI report next Wednesday. Who knows? You know, right now you're just getting a rising level on the Qs. You do have Celsius. I was looking at this. Celsius kind of coming off that $100 high, basically. Sitting at 79 bucks right now. Tesla's recovering. It's only down 1% right now, trying to get back to that 170 level. And so is Enphase bobbing on this 130 level. Last minute check here of any particular headlines or things that we ought to be covering, like Nick T. Good old Nick T. Let's see here. Nick T. Fidelity number finally in. Let's see here. Number of net Bitcoin ETF inflows on Thursday, 213 million. Highest since March 27th. It's pretty cool. Yeah. White House Brainard on CNBC. I think this is a really encouraging report. That's exciting. Okay. Then we have NATO chief. No. People are reluctant to lay people off, says Barkin. Yeah, that's an interesting one. Okay. Then we have, let's see what the if the Economist or the FT has anything new for us. No. Fed's inflation fight, not done yet. 303K jobs, fine. Investors reduce bet on interest rate cuts after stronger than expected jobs report. Yeah. Yeah, 10-year Treasury yield rose a little bit. Futures, well, futures are back. Rebounded from that pretty quickly. What about the Journal? Gains defy estimates as U.S. unemployment rate declines. Yeah, you know, actually, I think this Wall Street Journal piece is a really good cover because it shows you this chart of really how wage gains have been moving. And I'll throw it up on screen here in just a sec. It really doesn't scream that the Fed's rate cuts are doing anything to this market. So let's put that up on screen right here. So there you go. You know, it's wild because we hit peak rates maybe around here, and you know, if anything, we're higher. Look at these last 4 jobs reports. They're all higher than where we were when we started cutting or when we hit peak rate. So that is somewhat fascinating, and the economy is actually very enthused by that. So let's see here. Okay, so very interesting. Very, very interesting. So this is all on ehack.com. If you want to check out the all of the summary over at ehack.com, make sure to go to ehack.com. For now,
just close the fucking door. Close the door.
All right. Let's go ahead and push the button, and let's go see what BTC is doing, because I think it's actually recovering. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Ooh. So, I just extended that Bitcoin line, and we're right there. We're right there right now. 67.5. That's the trend. We're under it right now. Look at that. Trying to push through it. This is that longer term trend that we've been watching, and it's been pretty useful. You know, that drop almost right on it there, depending on how sort of perfectly you align it. But let's see how we end up behaving at the spot here. Again, market broadly green. Look at that. Qs getting to one of those day supports here at 438.90. And Tesla recovering. NVIDIA 2%. By the way, I'm also now lately, I don't know if I can always do it, but my goal now is I've been doing some evening news updates on this channel. It's really mostly just to support, like, for those of you who are like super interested in more content. It's easy for me to go live and just kind of do a summary of the end of the day's news on this channel. So when the market's open, 5:25 a.m., and then usually somewhere in the 6 o'clock-ish hour, although I haven't quite figured out yet what works best yet with the schedule for the kids and otherwise. So somewhere around there, I try to post a little evening news wrap-up, just sort of a live stream chat. I think it's kind of fun and casual. I don't have to edit a video or anything. So kind of fun. So somebody must be East Coast here. 10 p.m. live. Meet Kevin live is strange. Meet Kevin's always strange. Haven't you figured that out yet? Anyway, look at this. Substantial green here. So I'm going to go make another cup of coffee, and then we're going to be in the course member live. Looks like the only things really moving down today are interest rate sensitive, Enphase leading the way down. Donald Trump's back. Tesla's actually not doing that bad on this, honestly. This is, 89 bips, big deal. And back to rally mode on AI chips. Cheers, folks. See you soon.